The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A somewhat tepid end to a somewhat tepid week for U.S. financial markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking you off to the closing bell here in the U.S. It definitely felt like we started the week with a bang and it's ending with a whimper.
Yeah, I think the market's really trying to figure out what comes next.
Absolutely. All right, let's take a look at where markets stand right now, because whatever the S&P 500 does today determines whether it ends the week with losses or gains. And right now we are looking at a decline for the week, the holiday shortened week. You're looking at weakness in semiconductor names on concerns that trade tensions with China will ratchet higher. We're seeing the shorter end of the yield curve outperform the longer end here. 2 days after the Fed left rates unchanged, Fed Governor Chris Wallace said rate cuts could begin as early as July. And Brent crude moving down 2.25% on relief that the U.S. is not looking to take any kind of immediate military action against Iran.
Yeah, still holding that 77 level there, but we go back to the equity markets here in 2 straight weeks of significant gains for the S&P, now facing 2 straight weeks of fractional losses. That higher open today, that was on the back of dovish rate cut comments from Fed Governor Wallace, but that flipped to a touch of bearishness after a report that the U.S. could expand curbs on semiconductor sales to China, a reminder of the many loose geopolitical strings still flapping in the wind.
We're in an environment where it's very easy to be bearish, and it's not that easy to be bullish right now.
And that sentiment helping to keep the trading range tight. Remember, it was just 2 weeks ago when it looked like the S&P was actually breaking out toward fresh record highs. Now it's really being stuffed back into a hamper. Peak to trough intraday swings for the S&P this holiday shortened week, that's shaping up right now to be the narrowest of the year. Now, to be sure, the price action could widen over the next hour in a big way amid the quarterly triple witching. That's the day when options contracts on stocks, indexes, and futures all expire at the same time. The key thing to watch, though, is how dealers reposition around the increase over the past month in the so-called positive gamma, which, of course, created those outsized incentives last month to sell into rallies, Scarlett, and buy into the dips.
Right. Well, maybe as those options positions roll off, the stock market may be more sensitive to sharper moves in either direction. Take a look at this chart here. The white line is the S&P 500, and here's a tight trading range that Romaine was just talking about over the last 2 weeks, which has provided cover for some fairly weak market breadth, the extent to which the benchmark moves are reflected in individual stocks. In early May, the S&P reclaimed its 200-day moving average as long-term trend line and really hasn't looked back. Yet, less than half of the S&P 500's 500 members are trading above their 200-day moving average. That is the blue line right there. And you can see the widening gap here between the white line and the blue line as compared to, say, earlier in the year. Without greater participation, it may prove difficult for the S&P 500 to broaden its trading range or remain even spark a new trend entirely.
Anthony Saglimbene kicks us off to the close here on this Friday afternoon, chief market strategist with Ameriprise Financial. And Anthony, that is a big question that I think we have to start addressing at some point, is when does breadth return? And I specifically use the word return because it seemed like we've had a few bouts this year where it did look like the rally was broadening. But then, of course, as soon as something negative popped up out there, we saw everyone retreat back to the safety.
Yeah, I mean, earlier this month, it looked like the S&P 500 was at least going to get near its February all-time high. And then we saw Israel attack Iran, and markets have been kind of stuck in neutral. And really, since that big pop in May, markets have had a hard time climbing higher because of some of what you guys have been highlighting. There's a lot of unease and tension around trade. Obviously, the Middle East tensions have intensified some unease, and it's really just the handful of mega cap big tech stocks that have moved the markets higher. The rest of the market has kind of been stuck in neutral because it doesn't really know what the trade environment is going to look like, what economic and profit conditions are going to look like over the next couple months. Fed Chair Powell even said growth is likely to slow this year and inflation is likely to rise because of the uncertainty around tariffs. So it's not a surprise that stocks have been stuck in neutral, but I would take a little bit more of a bullish kind of view of that, is the markets have been incredibly resilient despite all of the uncertainty that we've faced.
And I've actually been kind of surprised by that. But then when you talk about this idea that we still haven't seen economic data to show a real meaningful impact from tariffs, we've gotten to an earnings season that at least seemed to show resiliency, for lack of a better word. And we talk about this idea potentially that the Fed at least is willing to cut rates should they feel the need to do so, which I would think would suggest some sort of a floor, a put, if you will, in this market.
Yeah, I think we're going to get a lot more information next month. Obviously, the July 9th deadline for the reciprocal tariffs. We'll see if we get more trade deals with some of our closest trading partners like Europe and Canada and Mexico. So I think there's an open question of, can the trade environment get a little bit better? If it gets a little bit worse, you're likely to see economic conditions start to reflect that a little bit more. So as we get more information around employment and manufacturing and services activity, inflation, investors and the Fed will get a little bit more read about what the impacts of trade are on the economic environment. And I would say that, based on what we heard from the Fed on Wednesday, their expectation is that growth will slow, inflation will rise a little bit. They're comfortable leaving interest rates where they are because the economic environment has remained pretty stable. If we see conditions deteriorate for whatever reason, I do believe the Fed has ample room to lower interest rates. And that's kind of the message we saw from Waller. He talked about a July cut, but it was conditional on inflation coming down, and we just need to see more information on that.
Yeah, we got to wait for the data to back that up. You mentioned the July 9th deadline. In terms of these deadlines, we know the president has delayed decisions or rolled it off or talked about waiting 2 weeks. That's the case for the U.S.'s role in the Iran-Israel war. He's delayed tariffs by 90 days until July 9th, but we'll see if he rolls that over again. What does this mean, this constant rolling over of deadlines mean for institutional investors who are looking to make allocations decisions and can't yet because they just need some measure of certainty?
It's very difficult, and you kind of heard that tone from Powell on Wednesday in his press conferences, that it's very difficult to forecast the environment over the next couple months and the next couple quarters. And so our view, especially from an investment standpoint, is it's really hard. It's easy to be bearish. It's hard to be bullish. So you should be balanced right now, balanced in terms of the way that you're allocating across stocks, bonds, alternatives, cash. If you're a CEO, it's very difficult to make forecasts about growth and about even capital expenditures and investments. And so what you see is companies kind of sit on their hands a little bit more. But I think in the absence of having clarity around what the trade environment is going to look like, you're going to see fits and starts in the market, which tells us, and which what we communicate to our advisors and clients, is to remain balanced. Don't take too much of a negative view or too much of an optimistic view. Just try to maintain balance in terms of your allocations and your overall approach, and we'll navigate through this period of uncertainty.
Let me ask you a dumb question. Usually it's sell in May and go away. We're in a supposedly weak period for stocks right now. Do the old market adages apply in this kind of environment when there's a lot of things that are just not certain?
Over the last couple of years, it hasn't. And so, you've seen stocks do pretty well in the summer months. I would say at this point, there is a little bit of complacency in the market, right? I mean, markets are sitting near all-time highs. We don't know what the trade environment's going to look like. We don't know what the impacts on profits are going to be. We actually saw profit estimates go down for most of the last couple months. And so it's going to be much more important for investors to learn what the impacts are on profits. And we're going to actually get to see some of that in June or in July and August when companies are reporting. So I think there is some concern that you could see volatility rise in the summer. But as we saw in April, particularly for companies that are growing profits and kind of more immune from the macro environment, any kind of downturn in some of these stocks, technology being one of them, is likely going to be a buying opportunity for longer-term investors.
All right, Anthony, have a wonderful weekend. Anthony Saglimbene, Chief Market Strategist with Ameriprise Financial, kicking us off to the close here on this Friday afternoon. When we come back, a discussion about nuclear energy and the torrid rise that we've seen in stocks in that space. A conversation up ahead with the CEO of Oklo.
From nuclear energy back to fossil fuels, we'll discuss shock-proof oil stocks and other areas where investors should park their money with Cole Smead, CEO of Smead Capital Management.
And from the equity market to the credit market, a discussion on how innovations in that space are leaning fixed income to trade a lot more like equities. Sonali Theisen over at Bank of America going to be joining us a little bit later in the program. Stick with us. A lot more coming up. This is a close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Circle. Seaport Global initiating coverage of the stablecoin issuer with a buy rating and a $235 price target. The firm says Circle is a, quote, top-tier crypto disruptor with a sizable future opportunity, especially after the U.S. Senate passed legislation that sets oversight for cryptocurrencies pegged to the dollar. Those shares up 20% on the day and up sevenfold since its IPO back on June 4th. Up next, Netflix, pivotal research boosting its price target to a street high $1,600 from $1,350, reiterating a buy with the analyst seeing Netflix as the dominant global streaming service and says the company's aspirational goal to reach a $1 trillion market cap by 2030, that actually seems reasonable. The share is fractionally higher on the day, on its way to a market cap right now of about $523 billion. And finally, Mondelez. Wells Fargo upgrading the stock to overweight, upping the price target to 78 from 68, saying the bull case for the maker of Oreos and Triscuits becoming more tangible. Those shares up about 3% on the day, right now flirting with their highest levels since late November. Now, those are some of our top calls, but we do want to stay, of course, in the consumer space, particularly when it comes to consumer products. There was a lot of talk this morning about the results that we got out of grocers like Kroger and out of restaurant companies like Darden. Darden, of course, is the owner of the chain Olive Garden. You know it, we love it. And sales there did top estimates. Joining us right now to talk a little bit about what we learned and, more importantly, what may happen going forward is Chris Oklo, managing director over at Stifel. He's got a buy rating on the stock. You can see the shares relatively unchanged on the day. We should point out shares that I believe earlier this week hit a record high. And it gets to this question right now, Chris, what is the state right now of this type, I guess, of casual dining, if you will?
Yeah, actually, casual dining is doing quite well right now. I think one of the things that they're benefiting from is just less pricing than some of the other categories like limited service restaurants. So over the past few years, they've been more judicious raising prices, whereas you're seeing more of the fast food chains have been aggressive. And I think that's benefiting casual dining right now because they have a strong value proposition.
Is this about the brand itself, Chris, or is this just about management itself?
I think it's a combination of both. You know, the Olive Garden brand and Longhorn are both very popular brands with a lot of guests visiting them each week. And then you have a very strong management team who identifies consumer trends and responds to it. I think in the case of Olive Garden recently, they brought back the buy one, take one, starting at $14.99. It's the first time they've brought that back in 5 years. And so you're seeing the benefits of them recognizing the need for value on the menu.
What's the danger of rolling out these popular promotions at a time of rising commodity prices? I mean, how long can the companies stick with it before they need to make adjustments or even remove them?
So far, the commodity environment has been fairly benign for restaurants. And a lot of the things that Darden can benefit from is just its growing scale. They made an acquisition last year of Chuy's restaurants, which just benefits their purchasing power. But Darden also is able to find productivity improvements through use of technology and through just changes to processes to offset some of the inflation. But I think they recognize that the key here is to reinvest in the business and grow same-store sales.
Darden's CEO, Rick Cardenas, said that they're considering strategic alternatives for the Bahama Breeze chain. Potential plans could include converting the restaurants to other Darden brands like Olive Garden or Longhorn, or just selling it outright. What's the best-case scenario from where you sit?
We think it's a good decision because Bahama Breeze was never really going to be a material contributor to Darden. And I think also it was going to require quite a bit of investment to really get it to a point where it could compete for capital within the company to be able to grow. So I think it makes a lot of sense to either convert the restaurants to the brands that have had a lot of success growing, like Olive Garden and Longhorn, or to sell it.
Is there with regards to selling it, Chris, I mean, there's been a lot of discussion for other restaurant chains out there that are considering reducing their footprint. And we've seen this in the retail space overall. The idea that real estate prices right now aren't necessarily cooperative with that strategy. I wonder if Olive Garden's locations are maybe in areas where the current real estate environment would be more favorable. Or Bahama Breeze, sorry.
I think it probably is. Yeah. I think it probably is. I mean, look, they put these restaurants in very popular consumer areas, but I think what they would look to do is maybe just not sell the real estate, but potentially sell the concept itself to a private equity buyer or another restaurant chain. But it could be even in the private markets. But I could also see them converting some of those Bahama Breeze into some of their other businesses, just because the real estate probably is very attractive.
Chris Oklo, Managing Director at Stifel Financial, thank you so much for joining us today, talking about Darden restaurants. Now, coming up, we're going to speak with Jacob DeWitte. He is CEO of Oklo, about the reemergence of nuclear energy and what's next for innovation in that space. This is Bloomberg. Oklo shares climbed to all-time highs this month as the wins piled up. The nuclear energy startup was named the intended winner of a key Defense Department contract and is also making progress in efforts to own and operate its first powerhouse. Oklo is one of the best-performing stocks over the past 12 months with a roughly 560% gain. Joining us now is Oklo's CEO and co-founder, Jacob DeWitte. Jacob, great to see you.
Thanks for having me on again.
The DoD will award Oklo a contract to build a nuclear reactor at an Air Force base in Alaska. What is the significance of this award for your company specifically and for the industry at large?
Yeah, I mean, it's exciting because it sets the stage for sort of opening a new market opportunity here, where for now, going back almost 10 years, there's been activity inside the Department of Defense looking at the opportunities to bring in the great features that nuclear power systems can bring in terms of providing, mission critical, resilient, reliable, clean power to bases. And this is the first one of those to move forward. So we're very excited to be selected for that opportunity and go into the next steps of kind of the contract kickoff and negotiation phases.
And you've acknowledged that the company is partially dependent on government funding, like investment and production tax credits, to finance the commercial development of these powerhouses, which makes you vulnerable to policy changes. And there's a lot of policy changes in Washington these days. Talk about the level of engagement that you or your senior team members are committing to tracking developments in Washington, making your case to lawmakers, to the White House. I mean, that's got to be time consuming.
Yeah, it is. Well, and I would say, it's more about maximizing the opportunity, right? It's clear that going back now several administrations and really clearly with this president, with the actions just 4 weeks ago today, signing those executive orders on nuclear, that nuclear is a clear priority from a policy perspective, given all the benefits it brings to the American people, right, and our economy. And so seeing that level of support and that activity is very encouraging. But we got to take advantage of all the tools we can have at our disposal for that. We've been rather excited to see where the Senate's landed with the developments on the investment tax credit in particular. But look, to be candid and very frank, we're not dependent on those. It's more of a matter of how quickly and how large you can scale nuclear deployment in this country. And I think it's clear that from a national policy perspective and priority perspective, the goal is to do it as soon as quickly, in which case we need all those tools. But when you couple those tools with the regulatory and permitting reform dynamics, as well as the clear sort of government contract and customer offtake signals that are being provided or have been provided by these executive orders, it's a perfect storm. So we do spend quite a bit of time on it because it's very important. I think of it more about playing offense than playing defense, because we've got to take advantage of the moment.
So Jacob, explain the difference from a regulatory aspect between doing something like the smaller modular reactors versus sort of the full-scale nuclear plants that many of us remember from our childhood.
Yeah, I think there's a lot of benefits. I mean, one thing that's really nice about smaller plants is you can build them more quickly, and you can also build more of them, which helps you on supply chain management. Something that's often, I think, forgotten is a really big plant that has single large equipment installs. You're only buying from your suppliers or your customers like one or two of these kinds of parts, maybe every couple years. When you're building more smaller plants, you're actually buying more constantly from your suppliers, which means you're going to get better economics. You're going to get better deals on them. You're going to have more resiliency in the supply chain because more people are going to work with you and you don't have the same susceptibility. It completely changes that. But the real thing that I think is really attractive is this allows for a much more incremental scale up with more sort of digestible increments of capital for building new plants, and then driving through how you learn to build these things more quickly and therefore more cheaply. If your cost of iteration is, just a matter of 1 to 2 years and on the order of hundreds of millions of dollars or less, that's way more palatable than something that's maybe $10 billion and takes 5 to 8 years, right? So there's a lot of benefits. But from a public perspective, look, these things have a smaller footprint. They're faster to build, easier to site near population centers, all sorts of benefits just because of the nature of being smaller.
Where are your customers going to be coming from in the future? Is it primarily going to be from the government or military side, or is this going to be mainly private companies, private industries tapping your expertise?
This is what's exciting is energy is such a foundational thing, right? Like having reliable electric power is such a foundational thing for all aspects of the economy. Really, the customers are everybody. But what we see is there's such a huge pull right now. Obviously, the data center piece is going to be the biggest piece right now. I mean, that's just it's hard to overstate how sizable that opportunity is and how the customer activity there is growing. We've announced about 14.4 gigawatts in a backlog, and the vast majority of that is on the data center side. But there are also really other important pieces. Obviously, contributing to national security is a really exciting mission for us personally, but also motivating to be able to partner with the government on a defense side of things. There's opportunity there. There's also opportunity just driving more power for, frankly, the industrialization activities occurring in the country. As we're looking at bringing manufacturing back in, we need a lot more power. I mean, one of the reasons we've seen power demand kind of stay flat in the 2010s was we were outsourcing a ton of that activity. Well, we're bringing it back in. We need that new power generation, and it needs to be reliable, and they want it to be clean. Nuclear is really well suited for that. So really, it's a mix. But we see government and data centers being some of those earliest movers.
I like what you said, how it's aligned with what the White House is trying to do in terms of bringing manufacturing back. You took advantage of the positive reception to the news of the intended DoD contract win by raising $460 million in a recent share offering. Are you done with capital raising in the foreseeable future?
Yeah, I mean, what we saw was, hey, like this what happened on the heels of the executive order, what was, and part of the announcement on the defense side with the Air Force Base in Alaska at Eielson builds on that, is allowing us to really sort of scale into a bigger opportunity set sooner than later. Like the world has really changed in nuclear in the last 4 weeks. I mean, there's been over $1.1 billion flown in investment, right? Us included in that. The prior 18 months, there was only about not even $1 billion invested. So you can see it's accelerating the case here. So it was clear hey, we can move a bit faster given some of the traction and the tailwinds from the executive orders. So it made sense to go to market to raise some money to actually move things to the left. So, we feel really good about where we're at on that position. But look, the world's still evolving. If there's opportunities to go faster and scale more quickly, we'll explore those. All right.
We got to leave it there. Jacob, really appreciate you taking time for us. That's the CEO and co-founder of Oklo, Jacob DeWitte, helping us count you down to the close. When we come back, a refocus on geopolitics and the situation in the Middle East. Ray Takeyh, who literally wrote the book on the situation in Iran, senior fellow at the Council of Foreign Relations. He joins us next. .30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Scarlett Fu. Happy Friday to everyone. President Trump says he will decide whether to strike Iran within the next 2 weeks to give time for diplomacy. Our next guest says this is a make or break moment. Joining us now to discuss is Ray Takeyh. He is senior fellow at the Council on Foreign Relations. Ray, good to speak with you. Before we get to the make or break moment, this idea that the president is opting to give diplomacy a chance, what does it actually look like? We know European officials are meeting with their Iranian counterparts in Geneva. Does that mean everything rests on those efforts by the European officials?
Well, I certainly hope not, because those meetings did not seem to yield any agreement, and I think they have broken up now without any sort of a breakthrough between the two sides. The president's emissary, Steve Witkoff, and Iranian Foreign Minister Abbas Araghchi appear to have been in touch with each other, whether directly or through emissaries. So there is some kind of a back channel conversation between the United States and Iran. But at this point, the demands of the international community, both the Europeans and the Americans, is for Iran to concede its domestic enrichment capability, and that still seems to be unacceptable to the Iranian government.
It still seems to be unacceptable, especially as long as as long as Israel continues to launch strikes against it. Is that the precondition for there to be a discussion before they would perhaps pause?
Well, their position is they have a right to enrich uranium for domestic energy purposes as part of the NPT membership. That is their position. And they do talk about creative arrangements that they could come in terms of diplomacy once Israeli attacks have ceased. But at this particular point, what has obstructed an agreement between the United States and Iran before the war continues to obstruct that agreement during this war, namely Iranian determination to maintain domestic enrichment capability.
I am curious, what is the relationship, the formal relationship right now between the U.S. and Iran, specifically on the heels of us pulling out of that nuclear agreement a few years ago, of course, during the first Trump administration? Has there been a relationship in the interim at all?
Well, not a relationship per se. There have been occasions when the two sides have held what they call indirect talks, usually mediated by Oman. Those indirect talks took place during the Biden administration, and they do obviously took place during the Trump administration. They would essentially involve the Iranian emissary and the American official being in separate rooms, and the Omanis would act as intermediary between the two sides, passing back and forth proposals and messages between the two sides. So it's been maybe there's been some direct contact as well. Yeah. But that's been the nature of the relationship.
Well, Ray, one reason why I ask is because I know we haven't gotten to the point where we should really seriously be talking about regime change. But when you start to think about what the end game might be for Netanyahu, and for that matter, if the U.S. is drawn into it, it's hard to see this ending in any other way than a regime change. You wrote a book recently about the last big regime change, of course, the fall of the last Shah of Iran, which of course led us to this fundamentalist government that we've had for the past few decades. Is that government, and I don't just mean the current head, but is that government overall and everything that it represents, is that in legitimate jeopardy of actually collapsing?
The Islamic Republic has always faced popular insurrections at home throughout its 45 years in power. It has never faced a crisis like this in terms of external intervention to this degree. At this point, I would say both the public and the government are too traumatized to contemplate what the post-Islamic Republic regime looks like, what the post-Islamic Republic polity looks like. So at this point, everybody's just trying to sort out what they're doing. The government is trying to sort out how to maintain continuity of government, how to essentially stop this war, while the public is trying to figure out how to survive in a country that is now being subject to external intervention, and you see bombing in major cities and so forth. So at this point, the more immediate concerns that both the public and the government have than what the post-Islamic Republic regime looks like.
Yeah. All right, Ray, really appreciate it. Ray Takeyh, Senior Fellow at the Council of Foreign Relations, a focus on the Mideast as we go now down to Washington, where the President of the United States is speaking.
We've been speaking to Iran, and we'll see what happens.
Mr. President, what was the thought process behind 2-week timetable?
Just time to see whether or not people come to their senses.
Mr. President, did the Europeans help at all in talking with the Iranians?
No, they didn't help. No. Iran doesn't want to speak to Europe. They want to speak to us. Europe is not going to be able to help in this one.
20 years ago, you were skeptical of a Republican administration that attacked a Middle East country on the idea of questionable intelligence of weapons of mass destruction. How is this moment different with Iran?
Well, there were no weapons of mass destruction. I never thought there were. And that was somewhat pre-nuclear. You know, there was a nuclear age, but nothing like it is today. And it looked like I'm right about the material that they've gathered already. It's a tremendous amount of material. And I think within a matter of weeks, or certainly within a matter of months, they're going to be able to have a nuclear weapon. We can't let that happen. I was very much opposed to Iraq. I said it loud and clear, but I was a civilian, but I guess I got a lot of publicity. But I was very much opposed to the Iraq war. And I actually did say, don't go in, don't go in, don't go in. But I said, if you're going to go in, keep the oil. But they didn't do that.
What intelligence do you have that Iran is building a nuclear weapon? Your intelligence community has said they have no evidence that they are at this point.
Well, then my intelligence community is wrong. Who in the intelligence community said that?
Your Director of National Intelligence, Tulsi Gabbard.
She's wrong.
Mr. President, are the Chinese in any way helping Iran in this moment? We're hearing reports of mysterious planes landing in Iran from China.
I don't know. They say that they're there to take people out, but I can't tell you about that. I get along very well with China, get along very well with President Xi. I like him. He likes me. We have a very good relationship. We'll see what happens. I can't imagine them getting involved.
Is this the decision that you need to make on Iran, whether to strike militarily? Is this the biggest decision you'll have to make as president?
Well, I can't tell you that. I have to see what happens. I can't, really say that. It depends what the decision is. But I wouldn't really be able to tell you that now. I'll tell you in about a year from now, maybe 5 years or 10 years from now. You never know about decisions. You never really know.
Would you support a ceasefire while the negotiations happen?
I might, depending on the circumstance.
Would you?
Former Congressman Matt
It's very hard to stop. I will say this. It's very hard to stop when you look at it. Israel's doing well in terms of war, and I think you would say that Iran is doing less well. It's a little bit hard to get somebody to stop.
Liam Cosgrove was here. Former Congressman Matt Gaetz threw out an interesting idea suggesting that if you were to broker a deal where nuclear inspectors go into both Israel and Iran, that you could win a Nobel Peace Prize, and they might even rename it the Trump Peace Prize. Did you hear those? What do you think of that?
Well, they should give me the Nobel Prize for Rwanda, and if you look at the Congo, or you could say Serbia, Kosovo, you could say a lot of them. You could say, the big one is India and Pakistan. I should have gotten it 4 or 5 times. I should get it for the I would think the Abraham Accords would be a good one, too. They won't give me a Nobel Peace Prize because they only give it to liberals.
Would you support Iran being able to have nuclear, or would you support Iran being able to have civilian nuclear energy capabilities up to 3.76%?
They're sitting on the top of one of the largest piles of oil in the world. I just don't know why they need that for civilian work. It's one thing for certain countries to say, hey, I want to have a certain amount where I could go nuclear a little bit because we need it for electricity, we need it for air conditioners, etc. But when you're sitting on one of the largest oil piles anywhere in the world, it's a little bit hard to see why you need that. Yeah.
Are you concerned that Iran or its proxies would wage terror attacks against American targets abroad if you order military action?
We're always concerned about that, and we have to take them out and be very strong. You're even in danger talking to me right now. Do you know that? You are in danger talking to me right now. So I should probably get out of here. But you guys are actually in danger. Can you believe it?
One more. Mr. President, is it still your expectation that NATO countries spend 5% of their GDP on defense spending?
Well, I think they should do that. I don't think we should, but I think they should. We've been supporting NATO so long. In many cases, I believe paying almost 100% the cost. So I don't think we should, but I think that the NATO countries should, absolutely.
And if a country like Spain decides not to?
Well, NATO's going to have to deal with Spain. Spain's been a very low payer. They were always a very low payer. They were either good negotiators or they weren't doing the right thing. I think Spain has to pay what everybody else has to pay. Spain has been notorious for low pay. You know who else was a low payer, just about the lowest? A place called Canada. Because Canada said, why should we pay when the United States will protect us free? And they've been right about that.
Ukraine, you've been making progress towards a peace deal, but I don't know if you know this, but Lindsey Graham and Mike Pompeo were there on the ground in Ukraine, seemingly doing the opposite, trying to provoke the Ukrainians to keep fighting. What do you think of that?
Well, we're going to see, and people have to be very careful with what they say. They got to be very careful with their mouth, because their mouth can get them into a lot of trouble.
One more. ICE has said that they're trying to arrest up to 3,000 individuals a day. There are some communities that are saying they are fearful of being wrongfully detained or separating some families, even if they are undocumented. Is the fear in some of these communities worth the deportations of these undocumented individuals, a mass deportation program?
It's a tough subject because, look, we have farmers. I love farmers. I won 80%, 85% of the farmers, and I love them, and I'm never going to do anything to hurt our farmers. And you can also say the leisure business, etc. There are some businesses where you have a disproportionate amount of people that are the people that you're talking about. At the same time, we have to get the criminals out of our country. And we're looking at doing something where, in the case of good, reputable farmers, they can take responsibility for the people that they hire and let them have responsibility, because we can't put the farms out of business. And at the same time, we don't want to hurt people that aren't criminals. Most of the people that came in over the last 3 years under Biden, I would say probably 3.5 to 4 years, those people, you have a lot of criminals, you have a lot of, we're looking at that very closely. You've had people that have worked on farms for 20 years. It's very hard to go in there and say, you're coming out. but we're going to let the farmers take responsibility. They're great people. They'll do it. They know the good and the bad. So the hard part about this is not like a normal war where people wear uniforms. They don't wear uniforms. But we have murderers that came out of the last 4 years. We have murderers. We have drug lords. We have people that we don't want to. We have prisoners. They emptied out Venezuela and many countries. They emptied out their prisons into the United States. We have to get those people out. But we have stone cold murders, 11,888 murders. We've already gotten a lot of them out of here, but we don't want them. So we have to be careful. But I never want to hurt our farmers. Our farmers are great people. They keep us happy and healthy and fat.
Are there other cities that you're going to try to replicate what you've done in Los Angeles?
Well, I mean, we had a big victory last night in the Court of Appeals with respect to Los Angeles, but really the country, where Gavin Newsom, who's really an incompetent governor, he's just doing a terrible job between his fires, between all the houses burning down, his forest fires, and now Los Angeles. If we didn't go to Los Angeles, and the sheriff admitted it, he had no control. He would have lost control. We saved Los Angeles by having the military go in. And the second night was much better. The third night was nothing much. And the fourth night, nobody bothered even coming. We put out that fire, and we did a great job of it. He sued us for going in and for helping him. We went and helped him. Right now, you'd have Los Angeles burning to the ground. Largely, it would have already been destroyed.
So do you think the implications should... President to be that of a peacemaker? Do you worry that striking Iran would change that?
Always a peacemaker. That doesn't mean sometimes you need some toughness to make peace, but always a peacemaker.
Can you win in Iran without ground forces?
Say it?
Is an aerial campaign in Iran enough, or do you need ground forces?
Well, I'm not going to talk about ground forces. The last thing you want to do is ground forces.
Does Iran have 2 weeks, or could you strike before that? Are you essentially giving them a 2-week timeline?
I'm giving them a period of time. We're going to see what that period of time is, but I'm giving them a period of time. And I would say 2 weeks would be the maximum.
Mr. President, do you think deportations should focus on criminals or all people who are here illegally?
Should start focusing on criminals, and that's what we've been focused on. Very bad criminals, dangerous criminals.
But Stephen Miller said to go out and arrest every person who's here illegally. He's told ICE to arrest everyone who's here illegally.
Stephen and I have a very good understanding. He is a terrific person. We have a great understanding.
Mr. President, if there is an attack on U.S. assets, will you promise to conduct a full investigation and make it transparent with the American people before blaming Iran for such an attack?
Well, if there's an attack, we'll know almost immediately with modern equipment who made the attack. And those people will be very, very unhappy.
Prime Minister...
I want to get you people out of danger. You're in danger standing with me.
One more. Prime Minister Netanyahu said that they had the capacity to take out all of Iran's nuclear facilities. So what role would the U.S. be able to play, and why would they, if Israel says that they have all of the abilities, their own military?
I'm not sure he said that, but they really have a very limited capacity. They can break through a little section, but they can't go down very deep. They don't have that capacity, and we'll have to see what happens. Maybe it won't be necessary. Maybe it won't be necessary.
Would you like to see Congress pass a bill that bans child transgender surgeries?
Well, I know they're talking about it, aren't they? Huh? We're going to have to see how it comes to me in what form. Certainly, it's been something I've been talking about also. Okay? Thank you.
Thank you, Mr. President. Appreciate it.
Thank you, everybody.
Thank you.
And you're watching the President of the United States walk away there at an airport in Morristown, New Jersey, as he makes his way to his private golf residence in Bedminster, New Jersey. The main headlines there in a wide-ranging series of questions and answers seem to center around the next steps in Iran, a 2-week deadline that the president has given, saying that is 2 weeks, and that's all that Iran is going to get. The president also making the point, in his view, that the U.S. should be the one talking to Iran, not necessarily Europe, and also says that Israel itself has limited capacity to take out Iran's facilities. Only the U.S. can do that. But, of course, dodging questions as to exactly what the U.S. involvement would be, whether that would just be aerial strikes or boots on the ground. Of course, all of this has created quite the wild ride that we've seen in financial markets, particularly when it comes to oil prices. Oil prices slightly lower on the day, but they are elevated for a third straight week. Our next guest is a big investor in that space, and he joins us right now. Cole Smead is the CEO and portfolio manager at Smead Capital Management, and he joins us today here in New York in Studio 2. Cole, great to see you. We talk about the increase that we've seen in oil prices over the last couple of weeks, and I know we're nowhere near kind of those lofty $100 plus levels that would be cause for panic. But I'm curious, to go from $60 up to 77 or wherever we were earlier this week, does that create opportunity for you, or is that something that you hedge against?
Yeah, it's a great question. This was a market that people were absolutely short in April. If you go to the 3 days after the Liberation Day was announced, you're sitting in a situation where it was economic fears really driving oil stocks and oil prices. Now, as we come out of this, we're finding out really quickly that wasn't the risk. The risk was not that OPEC Plus was going to be pumping. If you're really thinking about what's going on here, I would say foreign policy, one of the two big Fs we deal with in this country, beyond fiscal, is such a thing where all these problems drag on forever. Ukraine, how's that going? How's Gaza going? And we act like we're in 2 weeks, we're going to snap our fingers, we'll be back at $60 oil, and OPEC Plus will be pumping into that market. That just seems adorable. Okay. Here's one thing I will say. Yeah. You know, this is the energy markets are really left for dead. This is a part of the market that people during the 2000s really liked to play in. Commodities have got trounced by stocks. And so we sit in an era and a period where you can make really good money in the energy business on good returns of capital with not much leverage compared to the past. And what happens to Wall Street? They want nothing to do with it because the customers all remember how much money they lost.
So what specifically are you finding attractive there in that space?
Well, you guys have on the terminal, like we were talking about before today, we have a company, Strathcona, publicly traded up in Canada, that's going after another company we own called MEG. Adam Watrous, their chairman, is making this offer to heavy oil businesses that are going to get put together. And I was, at a dinner or an event here in New York and talking to other investors in this, and they all think it's not going to go through. But here's someone using effectively a PE roll-up strategy to go out and acquire assets using stock in this case. That deal will close, in our opinion. The question is just what price. And I say it because look at these entrepreneurial juices, an aggressor in the market, willing to scale up a business. But I mean, Romain, how many people want to scale up and roll up in the energy business? Yeah. That's what they do with laundromats here in New York, not oil businesses.
Do you think that's a template for other companies going in to do something similar?
Well, let's use the Chevron ExxonMobil fight over Hess as an example. They want a Guyana asset there. That's the main thing that they want for Hess. Whoever loses that will go out and find another asset like it. So, for example, we own IPA. They have an asset next door in Suriname. Total's their partner on that asset. They have a big Permian basin. They also have Egypt. To your point, think of the railroad businesses. There's 2 in Canada. We have 3 in America. That's what the energy business is going to look like. If you look at the XLE right now, it's already really just 2 stocks that are the primary makeup of that, Exxon and obviously Chevron. That's where we're going. That's the paradigm at play. Very few players, highly scaled business. It's an old, slow growth business. That's the end goal. So the question is, who goes out and buys who, when, and at what price, and what's the timing? That's all we're really dealing with. So the Strathcona MEG, this is the foreshadowing of the coming in the energy market.
So this idea that there's so much uncertainty from foreign policy, it's not going to get resolved anytime soon. So companies need to go out and just do what they're planning to do. And if you have scale, then that's to your advantage. How are investors positioned in the energy space prior to the Iran-Israel blowup?
Yeah, they're just not there. So
how does this change that, though?
Well, it hasn't yet. I mean, if you look at where the oil prices have moved and where these stocks sit, they're saying, nope, this is going to end quickly. Oil markets are going to go back down, and therefore these are not very investable securities. What I find keenly interesting is what part of foreign policy has ended in 2 weeks. Yeah. Okay, and so I think there's a real foolishness, a lethargy. But again, I'll use Buffett's quote: "The energy business is not a business you get really rich in. It's a business you stay really rich in." And here we have a bear market rally that just finished in the S&P 500. And the real question is, how are people going to want to make money in what looks like a pretty tough equity market?
All right, great stuff. Cole, really appreciate your joining us today. Cole Smead, CEO of Smead Capital Management. And as we head towards the close, we've got 10 minutes left in trading. And people thought there would be a lot of volatility, Romain, in the final hour or so. We haven't really seen that thus far. The indexes have barely moved in the final hour of trading, the first 50 minutes at least of this final hour. And because we do have options expiration today, but we're looking at a 0.5% decline here. Yeah,
we'll see a little bit of a pickup in volume over the next 10 minutes, but it looks like kind of what's in is already in. And it gets to the idea, too, as to what are you even repositioning around? I mean, I mean, I know we had some fireworks in April, but you think about May, things kind of settled down a lot. And a lot of dealers, I mean, they had already found a way to hedge their sales out of it. So maybe this won't be quite the fireworks that you would normally get, or maybe, I wouldn't say normally, but sometimes get on a triple witch.
Right, and everyone's waiting right now, right? We're all in some kind of waiting period, whether it's Iran, Israel, whether it's the Liberation Day tariffs extension. It's all a matter of waiting for more policy announcements to come through. Yeah, absolutely. As we count you down to the close with just about 8 minutes to go here, and we were taking a closer look at some of the factors that have been moving this market in the past week and really in the past month. And one of those factors is one called smart beta. Let's bring in Nguyen. She's Chief Investment Officer at Equity Strategies at Research Affiliates, and she has a new paper out called How Can Smart Beta Go Horribly Right? All right, I love the twist here on the pun here. Just explain just very succinctly here, when we talk about smart beta, what are we talking about?
We're talking about transparent strategies that are index-like, but they're not necessarily your standard indexes like S&P, Russell 1000. They may not be cap-weighted. They may be a little bit more selective, and they may tilt towards certain factors that have been discussed or researched in academia and by practitioners as well.
I'm curious as to how important this is. And when we talk about beta, the idea of sort of, if not necessarily chasing the market, at least trying to keep in lockstep with it. And that has become a very dominant form of our markets, particularly in the world of all these passive instruments out there. So when you try to pair the smart, quote unquote, with that beta, what do you get?
Well, hopefully what you're getting is something that outperforms the standard market. And you're also hopefully getting something that has capacity, right? Because for large institutional, for you and me, it may not matter, but for large institutional investors, it really does matter. They can get their assets into this strategy in size. And so that's why it's a beta, because it has capacity, and that's why it's smart, because it introduces things that can hopefully outperform over the long term.
Right, anything that's not market cap weighted. And you mentioned other factors. What factors stand out to you right now?
Right now, I think value and small or size stand out particularly well. I think low volatility had its moment in the first quarter, right? When everything was gyrating, markets were up and down, low vol really outperformed.
And low vol, do you anticipate a long tail for that going forward, given that we've been in this holding pattern for a couple of weeks now, and it's unlikely anything will change until we get some actual policy decisions, whether it's on tariffs or whether it's on geopolitics?
I think that's right. I think that if you basically are looking at a tough equity market where the upside is capped, low vol can hold its own. I think the other thing that's also important is that if you invest in these factors in a diversified way, so you're not just value, you're not just small, you're not just low vol, and you're constantly rebalancing in a market where the upside is limited, that rebalancing can help you a lot.
I am curious, coming out of this past earnings season, which is pretty much over, I mean, we're already talking about the next one already, there was this question as to whether expectations coming into the earnings season were too light. And I know we sort of jumped over that bar, a very low bar. But it raises the question as to, as you sort of map out over the next few quarters, is this going to be an EPS fundamental, bottom line, driven type of rally to this market? Is there enough there that you're seeing?
So I actually think that because earnings have been reasonably good, the market's not super expensive. It's not super cheap, but you're right. I do think that we are still going to need to see earnings growth. I think one of the things that's sort of interesting, though, is that it's not just earnings growth that's driven stock market performance. It's also valuation expansion. So if you look at the growthy aspects of the market, if you look at over the long history, EPS growth hasn't really been that dominant. What has really contributed to the outperformance is valuation expansion, which is why smart beta could have its moment in the sun soon.
But I question that valuation expansion. I mean, how much more can we expand valuation without everything else also expanding with it?
Right, and I think that that's the point of the paper, right? It's that it's not just value, it's that a certain part of the market has seen their valuations expand dramatically relative to everything else. And so if you want to take a look at the other everything else, how is it doing? And a lot of times what you see is that the earnings are okay, it's just that the valuations haven't kept up. And so as you rotate out of the really expensive stuff, go into some of the higher quality, less expensive things, there's an opportunity there.
How are you thinking about macro issues like, for instance, FX, the peak dollar? The peak dollar bearishness, some people are saying, is now behind us because if you look at the Bloomberg Dollar Index, it's seen a bit of a lift in the last couple of weeks. How much of a tailwind will the weak dollar provide for big companies in the second quarter, and how much of that is removed because of the fact that maybe the dollar's bearishness is over it?
I think that dollar bearishness is something, I think that, again, peak dollar is something interesting, right? Because I think we've always had administrations that wanted a strong dollar.
Yeah.
And I think now what we're seeing for the very first time is an administration who is, at best, indifferent to a strong dollar, right? And in some ways, they might actually prefer a weaker dollar. So, I think that we could see continued dollar weakness, just not the kind of dramatic dollar weakness we saw in the first quarter.
All right, Quay, I have to leave it there. Always great conversation, and another great paper out by her and her team over at Research Affiliates. Quay Nguyen, Chief Investment Officer of Equity Strategies at Research Affiliates. As we're just about 3 minutes until the closing bell, Scarlett, still on the back foot for most of the major indices.
Yeah, although we are seeing a spike in volume compared to, say, the last 5 days. Certainly picking up because of options expiration. And, of course, whatever happens in trading today for the S&P 500 really sets the tone for the week. Right now, we are looking at a decline here in the S&P 500 and a decline for the week.
Absolutely here, and it gets to the question, too. We should also point out this was a holiday-shortened week, so that's distorting things a little bit with the markets closed this past Thursday, and not a whole lot of action on tap for next week. Jay Powell is scheduled to speak, but the economic picture as well as the earnings picture is starting to wind down quite a bit. As we get closer to those closing bells, we're going to have a full breakdown of all of the action that happened on the day and on the week. That starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to the closing bell with a global simulcast. It's already started. There's Carol Massar and Tim Stenovic in the radio booth. Scarlett Fu, of course, by my side. Alex Steele off on the day as we welcome our audiences across all of our Bloomberg platforms. Carol Massar, you're smiling. The market is
because
smiling.
It's Friday.
No, yeah, it is Friday. Thank God. Thank God. Yeah, I know. It's kind of a funny market. I keep thinking about this story that was on the terminal about Goldman and Citi seeing Europe's economy powering the stock rally. And it made me look at the MSCI Europe Index. It is up about 5.5% year to date. S&P, folks, just up about 1.5%. So it'll be interesting to see if this trade takes us all the way till the end of this year.
You're already thinking about the end of the year?
Yeah, I am.
Okay, I'm just thinking about next week and what we hear from Jay Powell on Tuesday and Wednesday when he's on Capitol Hill. Are we going to hear anything different than we heard from him on Wednesday when he was at the press conference? Are the lawmakers going to get any additional answers out of him?
Certainly, he's not going to settle the debate between Chris Waller and Harker, right? That's not going to be resolved in his 2 appearances on Capitol Hill. I just think about the number of people who have said the stock market is priced to, be kind of best case scenario, even with this wall of worry that we face, whether it's geopolitics, whether it's trade developments, whether it's continued U.S. pushes to, restrict technology to China. There are all these things that typically would sink a lot of sectors, but isn't really.
Yeah, we had a guest on a couple of weeks ago. I thought put it best. He said kind of the best case scenario has already been priced in and the worst case scenario has actually been priced out. And that was his rationale for why we've been in such a tight trading range. We were in a tight trading range this week. In fact, I'll double check these numbers, but this actually might be the tightest trading range on the S&P on a weekly basis all year long. You see that reflected in the daily numbers on your screen with the Dow Jones Industrial Average hugging that 42,200 level, up about 30 points or just about 0.1% on the day. Meanwhile, the S&P closes once again below that 6,000 level, down about 13 points or 0.2%. The NASDAQ indices each down roughly about 0.5% on the day, while the Russell 2000 is going to close out the day lower by just about 4 points or about 0.2%.
All right, back to the S&P 500 I go. And folks, a little bit of a more positive tilt. Scarlett, you've got 298 names in the S&P 500 gaining ground on this Friday, 202 to the downside, 3 unchanged.
All right, let's take a look at the IMAP. Pretty much a mixed picture there as well. You've got 5 sectors in the green, 6 are in the red. The worst performances are communications services companies down 1.8%. After that, materials and healthcare each losing about 0.5%. On the upside, energy stocks gaining more than 1% on the day. Consumer staples and financials also finishing higher.
All right, to the individual gainers. Kroger, number one gainer in the S&P, nation's largest supermarket operator. Sales surpassing expectations. Comp sales coming in better than expectations, too. This is during the latest quarter. So consumers are still spending on groceries and other essentials, even amid economic turbulence. So the company raised its full-year guidance, reaffirmed the rest of its outlook, citing an uncertain, though, macroeconomic environment. So Kroger, as I said, number one gainer in the S&P 500. That stock up just shy of 10%. CarMax, an outperformer, up 9.5% at its highs, finishing with a 6.5% gain. Number three gainer in the S&P 500, reported first quarter comp sales and earnings per share that beat consensus estimates. Stock, though, is still down about 17% year to date. 8% of the float is shorted. So there's still some investors certainly with a wary eye to that one. GMS, this one up almost 24%. This company definitely in demand. Home Depot making an offer for the building product distributor, possibly setting off a bidding war with QXO, which this week made a $5 billion offer for the company. The Wall Street Journal reporting this out initially yesterday. QXO has come out and said it will not raise its $5 billion offer for the company. So keep an eye on this one. We'll probably watch that into next week. And
I love a good old-fashioned bidding war. I guess it's not a bidding war if QXO doesn't do anything, but close enough.
Okay, close enough.
Yeah.
We're gonna at least go with it. This is what I'm doing because Tim's like, Carol, you have to do Circle if you don't do anything else. Oh, wow. Circle Internet up another 20% today. This is the company behind USDC, second largest stablecoin by market share. Its shares rallying again in today's session. It's up about 670, maybe 70%. I meant to check the DES screen. It is up a lot since its IPO earlier this month.
We'll just round up, 700%.
Seaport Global, that came out and gave it its first buy rating in the wake of the U.S. Senate's move this past week to pass legislation setting up regulatory rules for cryptocurrencies pegged to the dollar. So, yeah. A super outperformer here. You're welcome.
About time you did
welcome.
Circle, okay?
I know.
It's been up like every day.
He's been on my case today.
I have. Hey, I want to get to the decliners. NVIDIA shares falling today by about 1.2%. I watched shares of chip companies after the Journal reported that the U.S. Commerce Department, or rather an official in the U.S. Commerce Department, has told top semi companies that he wants to revoke those waivers they've used to access American tech in China. We saw Lam Research fall, Applied Materials, KLA. They were among the biggest decliners in the stocks. NVIDIA, though, also falling today about 1.2%. Also, keep an eye on shares of Accenture. They were down as much as close to 11% after the company reported results. Analysts highlighted bookings as a weak spot. Bookings were down 7%. Bloomberg Intelligence says that decline lower suggests soft discretionary IT demand. The CEO in the earnings call, Julie Sweet, said the company, quote, continues to see a significantly elevated level of uncertainty in the global economic and geopolitical environment as compared to calendar year 2024. Interestingly, though, as opposed to what we saw with Booz Allen a few weeks ago, the company said that the federal business division had an immaterial impact on the overall growth of the quarter. Shares down 6.9% today. And finally, Smith & Wesson Brands. I didn't realize this was such a small market cap company. It's like $380 million company, $386 million company. Shares down 20% today. They reported adjusted earnings per share for the fourth quarter that missed the average analyst estimate. The president and CEO, Mark Smith, said, looking at the overall firearms market, we continue to see consumers generally being cautious due to macroeconomic factors pressuring discretionary spending. So people are pulling back on all kinds of purchases, I guess, at least according to the CEO of Smith & Wesson.
All right, let's take a quick look at yields here. Modest declines across the curve here on this Friday afternoon. We should point out, on a weekly basis, it's really the short end of the curve that saw most of the action. Seeing yields there drop for a second straight week. Meanwhile, on the longer end of the curve, 10 to 30 years, you actually had an increase in yields here. So a steepening of the yield curve. In fact, the biggest steepening that we've seen in about a month on a weekly basis. And that, of course, is the setup heading into next week and beyond as folks, Carol, start to refocus in on macro conditions and especially on the labor market.
Yeah, and so well set up for what we want to talk about because July 3rd is our next monthly labor report. And we saw a story about about what's going on in terms of consultants to the U.S. government. And we talk about thousands of private government consultants are flooding the labor market after being laid off during the Trump administration's cost-cutting efforts. We're talking about job postings among 7 consulting companies singled out by the General Services Administration for contract cuts are down 27% since 2023 and 11% lower from a year ago. And you just wonder how this all starts to trickle into some of the labor data points and the impact on the economy.
And that includes Accenture, which I think Tim was just talking about. But I'm curious, too, as somebody who lived in Washington, I mean, the ripple effects of this can be pretty enormous. Exactly. I mean, this is a huge ecosystem. Remember, it's not just that one person's job, but it's everything that sort of goes into supporting the communities around that. And if these people are out of work and you're seeing less activity, I do wonder what that means for the region.
Look, I heard just this anecdote a couple months ago about somebody who did lose his job as a result of DOGE cuts. He was mentioning that at his kid's school, there were several households where both parents had lost work because one was a consultant. But these are all in the D.C. area. And you saw, but the question is, and since then, which of those jobs have actually come back at this point? And also, I mean, is there demand in other sectors or other industries for these folks who aren't necessarily finding it with these consulting roles that for so long seemed really consistent and, were there all the time?
Yeah, these are open questions, and it's going to take a while for it to all shake out, but it's certainly really devastating news for those who are affected, especially in that region. We've got another story that we're keeping an eye on here, and, Meta has done a really good job with these smart glasses. They're Ray-Ban smart glasses that our senior producer, Queenette, wears around the office all the time.
Does she?
Yes. Oh, my gosh. Whenever she's talking to herself and walking around with glasses on, it's because she's wearing those AI glasses. Well, Meta is now launching these new smart glasses models with Oklo, which is aimed at athletes, and they're going to enable video recording. They also have water resistance. There's a quote from a Meta executive who says that he's seen a lot of performance use cases with the Ray-Bans, like people wearing them on roller coasters, cycling, and being around water. Can you imagine wearing these things like on the roller coaster? They're like $400 if it falls out.
You just got to hold on to them while you're wearing them. Matt Miller was talking about these earlier today on Open Interest, and he did not think these are cool looking. I hadn't seen pictures of them when I was hearing him talk about them. These aren't bad. They kind of look like the old school Oakley frog skins from like the 80s and 90s. Remember, Luxottica owns Oakley. Luxottica also owns Ray-Ban.
They own everything.
They own everything. They don't own these glasses. They don't own these glasses.
Right, so you have the 2% of the addressable market.
Yeah, so it's the same parent company. Yeah. It kind of makes sense that this partnership happens. Yeah. Remember GoPros? Like this was the whole idea of GoPro. But I think this works.
Yeah, but I think the thing though that's smart about what Meta has been doing here is the idea of just, if you're going to take this technology, just make it look like a normal product. Like we don't need a futuristic headset or something like that.
Yeah.
I mean, we can talk about whether
like
you think
Apple
Okleys are cool or not, but it gets to this idea.
So this way, when we're recording you, nobody knows that we're recording you,
I will never
right?
talk to anyone wearing glasses from this point forward, because you have no idea. See, I'm recording you right now.
There's supposed to be a light that goes on with these.
There's no light. I blacked it out.
There's supposed to be a light.
I blacked it out.
It's creepy.
Tap right now.
It's creepy. All right, guys, that's a wrap.
On TikTok tonight.
Have a good weekend. Our cross-platform on radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Scarlett continuing there on TV. Tim and I continuing right here on Bloomberg Business Week Daily on Bloomberg Radio. We'll see you again, same time, same place on Monday.
Stick with us. We're going to walk through the factors that move the market this week. We're going to talk about market structure as well. Sonali Theisen up next here from Bank of America. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostick as we close out the week on a little bit of a down note here for U.S. financial markets. Remember, we came into this week and there was some sort of glimmer of hope here that we could see a material rebound. Overless, though, what you see on the screen for the day is more or less what you saw on the week. Fractional declines for the S&P 500 for a second straight week, coming off 2 straight weeks of actually relatively outsized gains. A similar tepid moves when it comes to the yield space. A lot of activity on the short end of the curve that did push yields lower. The long end of the curve. We saw that drift up just a little bit higher. Crude oil also pulled back just a little bit from the weekly highs that we saw above $77 a barrel. And keep an eye on Bitcoin, still holding at that 104,000 level, though we should point out on a weekly basis it is down, though there was a lot of activity in the broader crypto space where we did see material gains.
Absolutely. We saw the Senate, of course, pass the stablecoin legislation. We're seeing Circle, a big beneficiary of that, up 20% on the day. It's the company behind the second biggest stablecoin. Since going public on June 4th, Circle has rallied in 8 of the 11 trading days and is up some 700% since then. Today's catalyst was it got its first buy rating following the Senate passage of that bill. We're also seeing weakness in some semiconductor names, KLA, Tencor, and Lam Research. This on a report from the Wall Street Journal that the U.S. government may revoke waivers that the world's biggest chip makers like Samsung Electronics and Hynix of South Korea and TSMC of Taiwan currently use in their China-based factories. So this is part, of course, of the White House's crackdown on critical U.S. technology going to China. We'll be keeping an eye on this one. Romain.
And that really does bring us to our top story, Scarlett, of the moment, and that is how you separate the noise from the substance out there. Amid the wild ride that we've been on this week and last, it showed just how critical geopolitics are to financial markets, and at the same time, how inconsequential geopolitics are to financial markets as well. The reaction around the Iran-Israel conflict has eased. Diplomatic talks underway in Geneva. The brutal sell-off in the dollar appears to have found a bottom for now, and all the hand-wringing over tariff-induced inflation is still more theory than reality. On top of that, we just wrapped up a surprisingly decent earnings season. Overall earnings growth for the S&P at 13% last quarter, double what analysts had penciled in. That upside surprise has investors betting on upside earnings revisions that could maybe lead to an upside for this range-bound market. David Kostin's team over at Goldman last month more than doubled their full-year EPS growth estimate to about 7%. And then you had Morgan Stanley and Mike Wilson's team saying that leading indicators that they're looking at are pointing to a better EPS backdrop than many had expected. Chris Kane is quantitative equity strategist for Bloomberg Intelligence. He's been tracking EPS revisions, and his data shows investors are keenly tapped into any upswing. He joins us now for our Factor Friday, the market dynamics that moved the market on the week, and EPS revisions was a big part of that.
EPS revisions is really one of those, I would call them non-standard factors that we cover. But I would argue that investors should really pay attention. Certainly, EPS revisions are a driver of returns. So first, how we form this factor, what we do is we look at the forward quarter EPS estimates using best estimates or broker estimates, and how those estimates have changed over the last 3 months. That long-short factor is up about 12% over the last year, and that's really no fluke. If you can go back to 2010, high EPS revisions is up 800% cumulatively. Low EPS revision quintile up only 227%. That high EPS revision quintile even did that with lower risk, lower drawdown. So it's certainly something that investors should pay attention to.
What sectors are most highly represented by the high EPS revision factor?
Sure. So I should mention we do not do this factor sector neutral. So we let the sectors tilt. So that's why this is a interesting question. So utilities is number one. A third of the sector makes that high EPS revision quintile. Things like tech, things like communications, things like real estate are also overrepresented at about 30%. Things like materials and consumer staples are very underrepresented.
And what about other factor characteristics? What traditional factors does the high EPS revision portfolio look like?
So this is what we always do. When we have a non-traditional factor, we always want to see what kind of traditional factors does this look like, right? Or what is it like? I would categorize the high EPS revision portfolio as high momentum. That makes sense as it's done so well. Higher volatility than the index, growth-like, and negative on value, meaning more expensive. So a growth-like, high volatility portfolio that is a bit more expensive than the index.
All right, good stuff. Chris Kane of Bloomberg Intelligence. He's here every Friday for our Factor Friday.
And a close look at those equity factors, and that we now turn to the fixed income market and the market turmoil that we've seen has investors there actually exhibiting behavior that in the past would be maybe more akin to what we see in the equity space. Our next guest says there's been a big shift in the way people contextualize risk in fixed income, particularly as portfolio trading in corporate credit, as opposed to single issue trading, grows in prominence with more equity-like calculations of factors, maybe like the ones that we just discussed with Chris Kane. Sonali Theisen is global head of FICC e-trading and strategic investments at Bank of America, and she joins us here in studio too. Great to see you.
Great to see you as well.
We've talked before about portfolio trading in the credit space and how it is actually driving kind of a shift in the way that investors approach risk. Explain.
Yes, absolutely. So if you look at the corporate bond markets, we're now at about 20% of portfolio, the composition of trading being from dealer to client in portfolio trading. That's up 13 points in the last 3 or 4 years. That's come at the expense of, on a percentage term, growth in single bond trading. So we are really seeing, as you mentioned, this borrowing of protocols and practices from the equity markets. And I think, we're seeing clients have a few different focuses. They really now want to use portfolio trading not just in corporate bonds, but across their portfolio, whether that be EGBs or mortgages or munis, really cross-asset using the portfolio tools to be able to transact.
Is that increasing trading volume, or is it having the opposite effect?
Overall, volumes continue to grow, right? I mean, you were seasonally a bit subdued right at this moment, as well as for geopolitical reasons, but if you just look at the trend lines, year over year, quarter over quarter, volumes are growing, and the number of portfolio trades going through ETFs, futures. So it's actually, I think, the real growth in trading of credit is growing exponentially if you think about the fact that we're also using other tools in the toolkit that we also have from the equity markets.
Does this growing presence of portfolio trading increase volatility or suppress volatility?
That's a good question. I think it helps the markets behave more liquidly and have this dialogue by which, we talk about factors, features. It's a way to be long volatility in the market. In other words, the portfolio trades and ETFs as well, or, adjacently, they trade just the more that they're trading, they're making the liquid bonds sort of more liquid. You're sort of seeing this dispersion. Likewise, you're seeing the ability to have discussions about, the bonds that are less liquid and what that premium discount should be. So I think overall, it's allowing the market to turn over, as we've just seen, AUMs grow, issuance, sizes continue to be large. Portfolio trading, ETFs as well, are really allowing the market to turn over, not just in single bonds, but in portfolio fashion.
So it makes it a more functional market in many ways.
Exactly, more tools in the toolkit.
How big do you see that portfolio trading getting in credit and other parts of the fixed income market?
Yeah, that's a good question as well. So investment grade bonds is where, we've seen the biggest growth. We're now seeing actually a lot of focus. A lot of growth has happened more recently in the high yield space. Just if you look at where we are in terms of the cycle, there's a lot more interest in high yield. Over time, we'll probably also see an interest, I think, even more so on the EM side. So I don't know that there's going to be a natural cap for the number. If we're, let's say, at, again, 20% of client flows going through, it's not going to be 100%. It's probably not going to be 60%. We'll probably continue to see single-digit growth. But at some point, we're going to, equilibrate. I think we're starting to reach maturation in terms of the protocols available to the corporate bond market. We're in our teenage years, I like to say. Yeah. We've got a lot of different tools in the toolkit now for how to execute.
And this gets to the question, though, too, and Scarlett kind of touched on this idea of a more efficient market as you sort of introduce more of these tools, and more importantly, as they're adopted. I know artificial intelligence has been talked about a lot, whether it's true AI or just something that we're rebranding as AI. Does that accelerate the process of what we've already seen with the migration to more e-trading, portfolio trading, et cetera?
I think that AI will continue to improve the investment process in the way of analytics. We've deployed really interesting tools for our own sales and trading population, where we allow us to use not just our research and commentary, but then marry it with public data going back 10 years. And that's really helping us be more targeted in sort of the analytics and the information that we get to clients. In terms of the actual investment decisioning and pricing, I think that we still have a ways to go. Of course, machine learning and those types of tools have been embedded in our algos for quite some time. But I do think that we're starting to really see the benefits of some of these efficiencies.
Is this contained to the environment that we're in right now? Meaning we're in a very volatile environment. And I'm just not talking market volatility, but with politics and everything else, it is unusual. I mean, typically we do not see these types of day-to-day moves, week-to-week moves. And I'm curious, if we do get to a point where that dies down a bit, does that change the complexion of the data that you're tracking?
No, I think we're going to continue to see growth. And like I was saying, the number of tools in the toolkit, if you look at credit, if you look at rates, repo, U.S. Treasury futures, swaps, we now have a lot more tools for risk transformation in the marketplace. And I think that that will continue to be a trend. And the last time that I was here, it was just a quarter ago, I think, we were talking about, we're counting in single days the number of days the U.S. Treasury market was over $1 trillion of volume. Now we're safely, that's the average, right? And even though right now you're seeing a little bit of pullback in terms of market depth, or, bid offers are a bit wider, you now have so many more tools to trade with than you did several years ago. You have your U.S. Treasury futures, you have fixed income ETFs, you have the the treasuries, you have the swaps, and they're all working really well together. And I think that's the theme in fixed income markets. It's really this growth of product, of competition, of venues, and you're seeing that risk transformation happen more efficiently, and I think that will continue in all market conditions.
All right, Sonali, great stuff. Sonali Theisen, Global Head of FIC E-Trading and Strategic Investments at Bank of America, and she hit on quite a few points there, Scarlett, including, of course, on ETFs, and we've seen the evolution in the ETF space. It just used to be, okay, a few things attract equities, and now I can pretty much do anything I want, including in fixed income.
Right, fixed income is where all the growth has happened, and especially active fixed income. I mean, that's where everyone is seeing opportunity, and I think it plays nicely into what Sonali was saying. All right, well, speaking of fixed income, when we come back, we're going to take a look back at this day in history and the financial market tantrum on the heels of a big decision by the Fed in 2013 to ease its quantitative easing. This is Bloomberg. All right, let's go back in history to this week about a dozen years ago when the market reacted violently to Fed Chair Ben Bernanke making good on something he had told the market months before, that the world's largest central bank would begin tapering some of its quantitative easing policies that had buoyed financial markets worldwide, primarily by hovering up any excess bond supply. The drama unfolded first on May 20 in 2013 when Bernanke told Congress that the Fed may cut the pace of bond purchases at its next few meetings if policymakers saw sustained economic growth. Now, that May announcement sent benchmark Treasury yields from near historic lows of 1.6% to about 2.2% by mid-June. And then things got interesting. On June 19th, the Fed decision day, one that would have been an otherwise uneventful day, with interest rates left where they had been for 4.5 years, near 0%. But during the post-decision press conference that the Fed had only begun doing a year prior, Bernanke put the market on notice. The Fed would indeed scale back its bond purchases from $85 billion to about $65 billion a month. Yields shot up 17 basis points that day, 6 basis points the next day on June 20th, and 12 basis points on June 21st. In a matter of weeks, the S&P fell 8%, emerging market currencies plunged 5%, the dollar surged 4%, and yields hit 3%. Now, in an interesting quirk of history, it was current Fed Chief Jay Powell who was on the Fed board and had urged Bernanke at the time to announce the Fed taper when he did, a taper that ultimately the Fed had to walk back just a bit, just 2 Fed meetings later in mid-September when Bernanke capitulated with a surprise decision to refrain from reducing the central bank's unprecedented stimulus. It was a harsh lesson in the power and the narrow-mindedness of financial markets and a harsh lesson in the importance of precise Fed communication. Randy Quarles, who had stepped down months earlier from his role as vice chair of supervision at the Fed, telling Bloomberg at the time that the lesson of the taper tantrum was that you've got to telegraph what you're going to do well in advance. Scarlett? Yeah, you've got to gradually do it. And of course, they've learned their lesson because the Fed takes pains to communicate what it's going to do way in advance. They kind of what is the word? They kind of reflect out loud, Romaine, on what they're going to do and talk to each other about what the likely options are.
Yeah, absolutely.
All right, let's take a look at how markets closed on the day. We had a down day here for the S&P 500, as well for the NASDAQ, with chip makers under particular pressure. Yields coming down as well. From New York, this is Bloomberg.
As we wrap up this week, we look ahead to next week and one that could be a big week for politics here in the United States. Fed Chair Jerome Powell set to be on Capitol Hill for 2 days of testimony. The President of the United States, he's expected to meet with world leaders at the NATO summit. And Congress returning from recess as the Senate tries to tackle that big budget bill. Bloomberg's Joe Mathieu joins us right now, the co-host of Balance of Power. All right, so a big week for Washington, Joe. What's the most important thing that you're going to be watching?
Be watching the Senate, as a matter of fact, and what could be a vote as soon as Wednesday, Romaine, on the big, beautiful bill we talk so much about. That's what the president likes to call it, the tax and spending bill that would extend the Trump tax cuts and so forth. It's already passed the House. The question is what happens this weekend. You've heard about the bird bath, of course, when they actually take a look at this to see what can fit inside the parliamentarians' rules when it comes to reconciliation. We already had something kicked out today, and it's pretty important. Cutting funding for the Consumer Financial Protection Bureau is a no-go in this bill. And there could be more that comes out as well. Democrats are going to be meeting over the weekend and Republicans on the Senate Finance Committee on Sunday night. So we could be talking about this on Monday. It might not be the full wish list that Donald Trump has, including things like state-by-state AI regulations and so forth. That's the conversation that we're going to have now. If they get it done by Wednesday or Thursday, they could make that July 4 deadline, which is what the president is hoping for.
Speaking of the president, he is also expected to meet with some of his European counterparts, a big NATO summit. We just heard from him on the tarmac at an airport in New Jersey, addressing some of the issues, saying, it's still going to be a couple weeks before we get a decision on Iran. Do we have any insights, I guess, into what he wants those European leaders to know, and more importantly, what maybe some of those EU leaders would like the U.S. to know?
I hate to say it, but I'm not sure he cares, Romaine, based on the language that he heard there with reporters. He made it pretty clear that he wasn't concerned too much about what European leaders thought about it or their ability to negotiate a deal, knowing that the Iranian foreign minister sat down with what we call the E3 now, Britain, Germany, France. Those leaders sat down today in Geneva. And there's a real question about whether Donald Trump would take credible any agreement that would be made with those parties. He said this needs to be between the U.S. and Iran. The backdrop, though, with NATO here and our eyes on what's taking place in Ukraine will also be significant next week. The president, once again, is going to be spinning a couple of plates.
Joe Mathieu, you can catch him at the top of the hour, host of Bloomberg's Balance of Power, which will take a deeper dive into the politics of the day, the week, and beyond as we stick on that topic here on The Close, particularly coming off of that big meeting in Geneva, the start of some sort of diplomatic talks with regards to the situation in Israel and Iran. Of course, the president is expected to go to Geneva himself to meet with some of those world leaders, saying that there's still a substantial chance that Iran might actually come to the table on negotiations. Kim Wallace joins us right now. He is Senior Managing Director and Head of Washington Policy Research at 22V Research. And I do want to start with the situation going on in the Middle East and the idea that right now you really only have a couple of players really involved in this right now. Obviously, Israel itself, but the United States, or at least based on what Trump has been saying, Kim, he kind of sees the U.S. as being the main arbiter of anything that happens next, not the EU.
That's not too surprising. The president likes to negotiate, and he likes to negotiate on a global stage. His statements over the last week have been inconsistent, or as he would say, targeted at leaving people guessing on what his bottom line is. So one would expect that the president's going to stay engaged even through the NATO summit.
I am curious about some of the comments that he's made. He was asked specifically earlier today about the idea that there is intelligence out there that show that Iran was not nearly as far along in its nuclear capabilities as Israel said. And the Trump was very clear. When asked where that information came, said it came from his national security director, Tulsi Gabbard, and he said flat out that she's wrong. There was also a report that Pete Hegseth, the defense secretary, is not necessarily directly involved in any of the military planning should the U.S. decide to strike. Who's making the call? Is this all Trump?
It would appear that the president makes all the calls, and that's something that his cabinet by now would have to grow accustomed to. It's not new. It's not new from his first term in office, and it's certainly not new in the last 6 months. We've seen cabinet members surprised on issues related to trade, fiscal policy, geopolitics. It is, in fact, the president's management style.
There are two big deadlines out there right now that the president himself has officially laid out. The idea of getting this budget bill done potentially by the July 4th holiday, and these trade deals that are still up in the air that ostensibly have a July 9th deadline attached to them. Any chance that we see us meeting either one of those deadlines?
Do the easier one first, at least in my view, on trade. It's fairly clear to me that trading partners are slow walking. Japan today announced that it's not interested in further meetings right now with a demand of more defense spending. But other G18 partners are finding reason to go slower. And I think part of it, of course, is they want to see what the U.S. judiciary decides in light of the appeal of the Court of International Trade's decision that the president's basis for his trade strategy is unconstitutional. The president yesterday or the day before encouraged the judiciary not to expedite the appeals. I'm not sure exactly how to read that, but if one thought that they were going to win on appeal, you might think that you'd want to push it through sooner, especially since trading partners are very likely going to continue to slow roll trade negotiations until we find out his authority. On fiscal, absolutely, there are a lot of soft deadlines, but as Randy Quarles was saying in the segment you did, it's very difficult to convince people to do hard things when you have not prepared them for it. In this case, that applies to the war, but in fiscal, it applies to the deep cuts in Medicaid and Medicare that the Senate is contemplating. My sense is that while the fiscal procedure, getting through the birdbath and the parliamentarian scrub per the Budget Act of 74, that may become secondary. What may become primary early on in the week is the pushback against those Medicaid cuts.
I am curious, though, Kim, and particularly when it comes to those cuts. We have not seen a whole lot of political pushback to that. So is there really any impediment to the Republicans being able to get that through?
Well, the impediment is soft and silent for now, but we were saying the same thing about the president's push on trade through the end of April. Where was the pushback? He's been announcing what he announced on April 2nd, and people seem sanguine with it outside of the markets, of course. And what we found out was that the pressure had been building very strongly, quietly among voters, donors, and governors and mayors. I would expect that some of those same factions, especially mayors and governors who fund 40 to 50% of Medicaid and who feel the impact of access to health care, cost of health care among their constituents. My sense is that they've been speaking, well, my knowledge is they have been speaking very directly to members of the Senate. It's not above the waterline, if you will, because taking the president on through the media has not proven to be very successful for other elected officials.
Yeah, certainly so. All right, Kim, I have to leave it there. Have a wonderful weekend. One of the best in the business, Kim Wallace, head of Washington policy research at 22V Research. As we start to wrap up the week here with stocks on the back foot on the day, modest declines, at least for the S&P 500 on a weekly basis, though we should point out the NASDAQ and the Russell did manage to squeak out some gains on the week, and it was a wild week for oil there. You take a look, 74.93. We were above 77 at one point on the day. A bit of a pullback as people start to reassess the situation in the Middle East. A slight drop in oil on the day, a slight drop on Bitcoin as well, and the dollar exhibiting a rare bout of strength, at least for a weekly basis. We'll be back in a moment. This is The Close on Bloomberg. All right, we should point out Game 7 of the NBA Finals is this Sunday. That means the season's wrapping up, and the spotlight, at least when it comes to professional basketball, will now sort of shift to some of the other leagues out there. That includes the Big Three. You know Ice Cube. He's a music legend. He's an actor. He's a producer. He's also the co-founder of the Big Three League. This is 3-on-3 half-court basketball. And its latest season just tipped off last week. Week 2 starts, well, this Sunday. I had a chance to sit down with him to talk about the evolution of the league, the evolution of team valuations, and what's next for the sport overall. Take a listen.
Oh, it's more passion. You know, getting in people's face only goes so far. You know, you got to have the passion to win and the passion to step up to the competition. And that's what we provide. You know, we let athletes be themselves because nobody want to see robots play the game. You know, it's really about personality, entertainment, and good basketball. And so that's what we provide with the Big Three at a time in the summer where it's going to be hard to find a good game.
It's interesting. This is the first season, correct me if I'm wrong, the Big Three is basically focused in specific cities. So before it was kind of touring around, but now you have specific teams in Chicago, in Dallas, and a few other places here. What was the decision to switch from that touring format to a more traditional city-based format?
Growth. You know, we owned all the teams as far as the league. The teams were centrally owned. And we knew to grow this league, really, we had to have owners, team owners, who could really help us, you know, plant flags in these cities all around the country, even all around the world, because we're looking at London and Mexico City. So having owners was very important to grow the league and to expand past the teams we have to, 16, 20, 24, and so on. So it's the, start of the, kind of the beginning of the rest of our lives in a way, because now we can actually really see this league grow very fast.
How have valuations, the individual team valuations, been like? I mean, I've seen publicly a couple of numbers thrown around, but are you seeing a significant increase in those individual team valuations based on the way you would have valued them, a couple of years ago?
We're just at the beginning stages of it. So, right now we say you can get a team for a bargain basement price. But compared to other franchises that's out there. And so we feel like we got the greatest upside when it comes to our business model and how things are structured with the big three. So, we feel like, we're a great bet if you want to, flip or you in it for the long haul, So one day we'll be up there with the big boys and have those super valuations.
So I am curious as to where you see Big Three maybe 10 years from now, or 8 years from now, I should say, given that we're now 8 years from its inception.
Hopefully in that amount of time, you could be able to 10 times, 12 times what we're doing now. So, we do see that these franchises are going to scale up very fast. And people are going to make a lot of money, especially if they got in early. So, we do see the curve just going up.
But when we talk about like the legitimacy of Big Three, and I remember when it came out, there were a lot of people kind of scratching their head. Why do we need this? Why is Ice Cube involved? But now you look at a league that has big corporate partnerships, Procter & Gamble, a partnership with Starter. I was reading about this whole, we had the CEO of Red Lobster on the other day and was talking about the big promotion that they're doing with the Big Three. On top of that, you got Chris Haynes, just a legendary NBA reporter who's now going to make his home the Big Three. That's a big deal, right?
Yeah, but look at our history. We have Hall of Fame Commissioner Clyde Drexler. We have Hall of Fame coaches, from Dr. J to Iceman, George Gervin to Nancy Lieberman, Gary Payton, now Michael Cooper. We got Calvin Murphy. These are Hall of Fame players who are putting a stamp on this league. Some have been around since the inception of the league. So, we have staying power. They wouldn't be around. Dr. J wouldn't be around for 8 years if this wasn't something great. So we know we're, on the right path, and we've been stamped by the greatest that ever played the game. And so, it's really no one who can look at us and say that, this is a novelty. This is something that is very well respected throughout basketball.
Rapper Ice Cube there, the CEO and co-founder of the Big Three Basketball League. All right, we want to make a pivot from that to a segment that we do called Bloomberg Equality. Every week in the month of June, we've been diving into the impact of social equity and equality for companies and investors. And our next guest has an interesting perch. She trains thousands of young women for their first day in the workforce. And she says more than half of this year's graduating class is pessimistic about their chances in this labor market. Jennifer Openshaw joins us right now, the founder and chair of an organization called Girls with Impact. All right, Jen, it's always great to talk to you, though I'm a little alarmed by this survey here. Why is there so much pessimism? Is the idea that there just aren't jobs out there for these people?
Well, the next generation is feeling like it's much more competitive. Some companies are pulling back, as we know, others are not. But the big piece of data is that people who are in college and get personalized one-on-one help are much more likely to land a job, but yet only 1 in 5 students get that kind of help. And it's really sad, right? Very interestingly, I have wealthy families who come to me and they're looking to land their students in their next job. And what we see is students who come from networked and wealthy families are more likely to land that job. It is really important that they start thinking earlier about getting that internship and landing. And that's, Romaine, what we're trying to do with Girls with Impact, is to create this network of opportunities so that these less underserved young women have a chance at getting access to internships and getting that first job.
I am curious, though, about the generational differences. I mean, obviously, job markets change. They changed a lot since I came out. I'm a Gen Xer, technically. And we talk about sort of this new generation. I know some people have derided Gen Z, saying they just don't really respect the labor market the way that maybe we had to. But it's not so much an issue of respect. It's just their expectations for what they want out of their career and their lives. It's just going to be different. And I am curious as to how that syncs up with what corporations themselves are expecting out of entry-level workers these days.
Well, I think a lot of people, right, think that Gen Z doesn't have grit. They don't have the hustle. I think what's important to remember is that they have a very different definition of grit and hustle. To give you a sense, the typical Gen Zer is using AI twice a week in their job for productivity. That tells you something. But what we have to remember is that they're very strategic. A lot of them saw maybe their parents lose jobs, that the loyalty didn't pay off. They want purpose in their lives. They want an entrepreneurial impact, ideally, and they want to stretch themselves. And so the question is, what does this mean for corporate leaders? I think number one is, just like any other business case, is to connect the dots. And remember that this generation wants to be accountable. They want to feel ownership of something. And so what we even do with our own team is give them ownership, mentor them along the way. And I think what you'll find is they're much more capable than what we might think. In fact, of our generation, of course. And then the other is to remember that they want some purpose in their jobs. And so when you're hiring, don't hide the why in the job description. Make sure you talk about the role of the company, a sense of mission and purpose that connect to that young person's job.
I'm curious about the entrepreneurial side of this generation. There's been a lot of surveys and other sort of, I guess, anecdotal type of data that seems to suggest that this is a generation that definitely seems, or at least they feel like they need a much more entrepreneurial focus to their careers. And I'm wondering if we do see a lot of these folks bypass that traditional start at the entry level in a corporation and work your way up the ladder.
I think we definitely are seeing some of them go the entrepreneurial path. Some of them are in a traditional job and doing the entrepreneurial side gig. There is no question. I think the opportunity for business leaders actually is to harness that energy internally. One of the things that we are talking to large companies about is, can we bring our innovation academy inside to a company and allow these young people to innovate on the job? And so what does that accomplish? It helps with retention. It helps with potentially incubating some new ideas or helping clients in new ways that hadn't been imagined. So there are some ways to certainly leverage this young talent.
Obviously, you focus primarily on women, young women. And I am curious about where you see the environment right now in corporate America for women. We've talked a lot on this program over the years about what had been an expansion of leadership roles for women. And it feels, at least, and not just feels, but the data has shown that at least over the last couple of years, that growth has stalled just a bit.
Yeah, so women and men come into the workplace at 50-50 levels, right? And as we go up the ladder, we see fewer of them. Recent piece of data is that we see more women at the CEO level, just over 10%. But the side story there, Romaine, is that the women who are getting to the CEO slot generally held something like a president or a CEO position before that. One of the issues with women is that they don't always raise their hand for a job. Men tend to get promoted on a promise, women on performance. What does this mean? First off, huge economic impact that we're missing. So McKinsey even recently says, it's a $12 trillion untapped economic opportunity in the U.S. because women are not realizing their full potential. And that's what GWI is trying to do. The other interesting piece of data is that that women are resisting the leader label. Yeah. And despite outperforming, they just don't see themselves as leaders in the workplace.
All right, Jen, we got to leave it there. Always appreciate talking to you and doing some really important work there. organization is called Girls with Impact. That's Jennifer Openshaw. She's the founder and chair there, helping to train the next generation of young women for the workforce. All right, as we wrap up the week here on The Close, we're going to set you up for what could be a very consequential week for financial markets coming up after the break. All right, here's what markets will have their eye on over the next week. We're going to start with geopolitics. EU foreign ministers set to meet on Monday, and a big NATO summit on Tuesday that the President of the United States is scheduled to attend. Also keep an eye on monetary policy. Fed Chair Jay Powell will be on Capitol Hill for 2 days of testimony, and keep an eye on earnings. FedEx and Carnival on Tuesday, General Mills, Micron on Wednesday, Nike and Walgreens on Thursday, and keep an eye on the economic data. Friday, that will be the showstopper. The U.S. PCE data is released for the latest month, the Fed's preferred inflation gauge baked into that report. Full coverage of that right here on Bloomberg.